We're going through chapter 8. The chapter 8 talking about internal control and the cash, which makes sense, right? When you just talk about internal control and there's some cash related, should be easy. Okay, so this chapter covers the purpose, components, procedures of an effective system of internal control. Why are we gonna focus on the cash? Because cash is an asset that is very easy to get being stolen, and most companies have internal controls in place for cash. So we're going to focus on those two things. Now we're going to start from defining the internal control. What is the internal control? Internal control consists of process designed and put in place by management to provide reasonable assurance that the organization will achieve its objective of 1, reliable financial reporting, 2, effective and efficient operations, 3, compliance with applicable laws and regulations. So accounting scandals are involving companies operating in the United States and Canada. We have one kind of legislation from the United States. We called the Sarbanes-Oxley Act of 2002. We mentioned a little bit about that in our textbook, but it just, we didn't go that deep. But anyway, we follow the rules. Especially the act provides a very tough rules and penalties related to the internal control for all companies in both Canada or US. So those US or Canadian listed on American Stock Exchange and their auditors find in violations. So the rules works for most of the companies listed in the American Stock Exchange. Now, a common misconception is that the main purpose of internal control is to prevent or detect fraud. We always made aware of the fact that internal controls are designed to ensure that management's plan for operation, the organizations, are carried out, while preventing or detecting of fraud is a big part of this plan. Okay, so it is not a main purpose, but it's a very big plan on that to find the fraud. Now, so this is the SOX. We talk about the SOX, basically the Sarbanes-Oxley Act. The SOX has been used for most of the auditors. I used to work for an auditing group, so I'm in the internal audit, of course, so it's within the company. But the SOX is basically the rules, so we're gonna follow each one to audit the whole policies from the company to make sure that all the financial operations and follow the rules. Okay, so SOX is really important rules. Work for different ways. So there's impact of the SOX on Canadian companies. Now we move on to learning objective number 2. Why should we think about when designing an internal control system? Now we're going to talk about the components of internal control. The components of internal control include controlled environment, risk assessment, control procedures, monitoring of control information system. So you can see that it's very easy to remember because when you see the first capital of all the sentences of the components, it comes with crime. Okay? Because the crime is putting it into context. It helps even more that the 5 components help to prevent crime. So that is how that works, so you can remember. Now we talk about each of the component. First of all, it's control environment. The control environment, the owner must demonstrate the importance of internal control. So that is the control procedures talking about it. Risk assessment. Risk assessment is a business must identify its risk. Control procedures designed to ensure that the business goals are achieved. Monitoring of control. Monitoring control is auditors ensures that assets are safeguarded from loss or theft and that accounting records are accurate. Okay. Information system. The information system is critical to provide accurate information. So those are the components for the internal control. For internal control to be effective, all the components are required and need to work together. It is best when employees at all levels and in all areas take internal control seriously by adopting the organization's internal control objectives and ethical standard. So this is if there is internal control objectives and ethical standard, this is around in the organizations, this is considered to be a good control environment. So internal control procedures have the following characteristics. This is listed in there. First is competent, reliable, and ethical personnel. This is attract top quality employees, train them well, and supervise them. Assignment of responsibility. Each employee is assigned certain responsibilities. Often we defined in the organizational chart. You can see each person's responsibilities in the whole organization's chart. Number 3, proper authorizations. So proper authorizations means an organization generally has a written set of rules that outlines approved procedures. Tasks that fall outside that set of procedures may be performed only if properly authorized. So we have to make sure the proper authorization is in place. And then there's others also included, separation of duties. Separation of duties is dividing the responsibilities for transactions into the 3 tasks of authorization: recording, custody limits, the chance for fraud, and promotes accuracy of the accounting record. Separation of duties may be divided into 3 parts. It wasn't there? No. Separation of operation from accounting. Okay, so the entire accounting function should be completely separate from operating department. So that's why when if you work in a bigger company, the operation department and accounting department or finance department, internal control department are totally separated. So you have to make sure that the separation of duties is on place. And number 2, separation of custody of assets from accounting. So accountant should not have access to assets. Those that have access to assets should not have access to the accounting record. If you think about a retail store like a Dollarama, right? So the tailor, the cashier, should be separate from those people accountant in the store. So every time when you finish your duties, you have to calculate your cash, okay? And then the accountant should come out and calculate the cash to make sure that the numbers and the numbers and the cash are matched. Okay. And the other separation of duties, including the separation of authorization of transactions from the custody of related assets. People who authorize transactions should not handle the related assets. So that is the separation of duties. So if there might be some questions regarding, what if there's only 1 or 2 employees? How do we decide who should be assigned what kind of responsibilities? So in the case of only 1 employee, the owner will have active roles in day-to-day operations and is able to monitor or control activities personally. If you're working for a tax institution, see HR Block or Liberty Tax Service, those are very popular tax preparation firm. If you're working for there, during the tax peak season, like right now, March, right, January to April, basically a very super busy time. But if you after April, I mean, maybe June 15th, because that is the deadline for the business tax return. So July, August is going to be super slow time. Maybe there's only 1 person working there and plus the owner. Then in those kind of situations, the owners will have active roles, right, for day-to-day operations. So he should or she should be able to monitor and control for the internal control personally. In the case of 2 employees or 3, the management should take care when assigning the work responsibilities so that activities involving the custody and accounting for assets are not done by the same person. I could think good examples. You can think about it. If you go to HR Block, right, the front desk always be in the front, people who greeting you and gathering all the information and let you fill the form. You need to fill in your name, your information, basically your marital status, if you have any kids, what kind of form you have for the tax preparer. And the tax preparer will do your tax preparation. And then when you finish your tax preparation, you come back to the front desk people and to pay for your fee. So those are kind of a separation of duties, a very easy, simple examples for that. Now, internal controls for e-commerce. E-commerce, where is this in there? Okay, so we talk about buying and selling over the internet give rise to potential dangers. I believe most of us had experiences for online shopping. You have to enter your credit card number, or even though it's connected with your PayPal accounts. The pitfalls for consumers. Stolen credit card numbers. Your information must travel through cyberspace where wireless network assist hacker. So it might be stolen. Computer virus. So enter your computers without consent and cause damage to your system. Or identifications has been theft. So there are all sorts of things going to happen. Maybe theft of your personal data to steal your assets, make purchase or obtain the loans. I remember one of my friends, he been shopping from Amazon by entering his credit card numbers. And then one day when he found it out, his bills goes to 1,000, 2,000 because it's been stolen for some reason. It's not always happen, but it happens in there. So there's pitfalls. Some security measures, but not an exclusive list that companies can implement to protect the consumers. By firewalls, or there's some softwares to protect you guys. Okay. So the firewalls, for example, they limit access to a local network. So it will help. That is also kind of things like firewalls. If you work for a company, you are not allowed to download the software yourself. Right? You have to always go through your IT support centers, and the IT people will help you to download it because you want to make sure that there is a virus, there's not a virus, or there's firewalls. You actually cannot even download it by yourself. The limitation of internal control. There's cost and benefits. There are some limitation of internal control. An internal control system can only provide reasonable assurance, not absolute assurance, to avoid errors or fraud, right? So there are many reasons why. For example, internal control system can be circumvented by collusion between two or more people working together, right, to defraud the firm. Or internal controls will be implemented based on risk and the cost of benefits of internal control. That there will not be internal control procedures for every potential risk. So that's where we're talking about internal control. Now we're moving on to bank reconciliation. Be careful to this topic because you will see a lot of exercises and your final exams related to the bank reconciliation. They will ask you to do the bank reconciliation. They will ask you to prepare a journal entry. Okay, so what do we do when the bank statements balance and the cash account balance are not the same? Now we're going to start talking about cash first. Cash, easy. Items including cash are cash on hand, petty cash, cash on deposit in bank and trust companies, cash equivalent. Okay. Cash is the most liquid asset of an organization. Cash's liquidity can be considered disadvantaged because it's so easy to get stolen. The bank account as a control device. So the bank account is a control device because banks have this established practices for safeguarding cash. Banks provide depositors with a detailed record of cash transactions. We should have examples. Yes, remittance advice. So you can see that this illustrated cash account. The documents used to control a bank account, including signature card, to ensure that only an authorized person has access to the account. Deposit slips maintain a record of amount deposit. Checks to maintain a record of monies withdrawn from the bank, including the date of the bank and the name of the payee and the signature of the maker. So this is actually shows the money has been drawn from the bank, right, from your cash account. Now, there are also a bank statement that we talk about it. If it's a bank statement to show the monthly activities in account, including with bank statements are canceled checks that have been cashed by the payee or copied of these checks, or the EFT, electronic fund transfers. Normally, we've been use EFT a lot, right? Even though your employees, your employer EFT your salaries to your bank account directly. So EFT are paperless transactions that move cash to or from a bank account. So the bank statement lists the EFT transactions as well. There are two records kept of a company's cash transaction. The cash account is the general ledger and the cash account at the bank. So that is actually the two things you need to compare, right? The two records. One is the general ledger of the cash account, another is the bank statement. Due to the timing differences, the ending balance in those two cash accounts rarely agree. It's always been different because the timing differences. For example, if you deposit $1,000 at the end of the last day, we see March the 31st, and then your bank statements probably won't record this amount because they will record it as a deposit in transit, which means you record it in your books. You're saying I have a deposit for $1,000, but from the bank side, they're not recorded in their deposit because it's deposit in transit. So that is the reason we need a reconciliation. We're going to talk about it later, okay? So the bank reconciliation, a document prepared by the company that explains the differences, accounts for all the cash transactions, and establishes that the balance are accurate. Examples of items that would cause timing differences and would be included on the bank reconciliations are listed. Let's see if it's listed in there. Now we have this item recorded by a company in the general ledger, but not yet recorded by the bank, including, we just talked about this, right? The deposit in transit. So we deposit, but the bank hasn't. And there are outstanding checks, which means those are not being paid off or being taken off yet. Those are outstanding checks. And electronic fund transfer. So that has always been the one has been transferred but haven't been received by the bank account yet. And also there's a bank errors. Now items recorded by the bank but not yet recorded by the business side. For example, the bank connection. Sometimes when business has their clients, so the clients pays their account payable. So they paid cash to the company directly to the bank account. The bank will record it on their side, but from the company side, they didn't see that money. So they're not going to record it for that month. Then there is a differences, right? So the bank had a connection, but it's not recorded in the book. The EFT receipts and payments. So the bank directly pay, for example, utility bills. The bank probably just took the money from your account and paid the utility bills by the date you have been set with the company, with the bank. I mean, maybe first day of the month. So they just took the money directly to the utility company. But the books from your company probably will not record this amount. And the money has been just taken off from your bank account. Service charge, we know that there's always been a service charge from the bank side. Interest revenue on checking account. So maybe there's a notes receivable or there's some receivables. There's an interest included. There's going to be an interest revenue going to record it from the bank side. Non-sufficient funds. This is an interesting one because that means the non-sufficient checks received from the customer and returned to the payee. They're sometimes included in the bank statements as well, which means the customer doesn't have enough money in their bank account. So when the bank tried to withdraw the money, it just had seen that there's non-sufficient, so it's bounced check, right? Even so, normally if there is a bounce check, like if there is a non-sufficient funds check, bank will charge a bank service fee. So they're probably around $25, I remember. So it's for non-sufficient funds. And also they're gonna charge the customer. Well, this is from the company, right? So like, well, I'm gonna give examples. See, if I'm selling apples, I'm like an apple farmer. Now, so the customers paid me $200 for the apples I sold them. The bank, they give the check. I deposit the check to the bank, and then find it out as a non-sufficient funds. So there's no $200 in the bank account. Then the bank will charge $20 for the service fee for me. I'm the farmer, I'm the seller. And then me, I will charge probably around $30 to the customer. So plus the $200 non-sufficient funds, the customer needs to pay me $30 more because there's a customer service fee, okay? Because for all the non-sufficient funds. So that is how that works. You will see some examples from the textbook. And then the cost of printed check, that is a fee that the bank charges for printing the check. Yeah, sometimes they do. And bank errors. So the may need to be added or subtracted from the book balance. We'll have to see examples regarding that. Now, the bank reconciliation. Remember this form. Okay, memorize it. Because those are the account that always stay in there. There's no change. Just be careful for the bank errors. Sometimes it's going to be added into your bank or deduct your bank. So, but deposit in transit is always added back to the bank. Outstanding checks is always deducted from the bank. Okay, on the book side, always bank connections will have to add it back. EFT receipts, sometimes you have to add or deduct. But bank service fee, you have to deduct it always on the book side. Interest revenue, always have to add it in. Non-sufficient checks, it's always been deducted. And check printing costs, always deducted. So memorize that form, very important. You will see a lot of questions related to this, okay? Now, we're gonna see the examples right there. Get smaller here. Business Research Inc. Book site indicate a balance of $3,294.21. The bank statements shows a balance of $5,902.48. So you can see that they're different, right? So bank recording has to be a bit more than your book recording. Now the reconcile items, including the following. There's deposit in transit, $1,591. Bank error. The bank deduct $100 for a check written by another company. So they deduct more, right? So they have to add it back. Do you see that? So the bank, why we see that bank error sometimes have to add it back or deduct it. For this specific scenarios, they have to deduct it because the bank charged something we're not supposed to pay, right, from the company. So we have to add this back. Outstanding checks, we have 337, 338, 339, 340, 341. So numbers are outstanding checks. Remember, outstanding checks always deduct from the bank side, right? EFT receipts of rent revenue. So bank received this EFT receipts, but not book yet. So this has to add it back to your book side. Or keep going. Bank connection of notes receivable 2,100, including the interest to revenue. So bank connection of this notes receivable, which is the money we're supposed to record in our book side. Interest earned on bank balance 28, added back. Book errors, check number 333 for 150 paid to Brian was recorded as 5110. So we have to know the differences, right? That means we are supposed to record 150, but we record 300 something more. So we have to deduct it. Book service charge, bank service charge, always deducted. Remember, non-sufficient funds check from this company, $50. EFT payment to insurance expenses, $360. So when you take a look at the bank reconciliation, all those scenarios we just went through, as shows in here. So this is also a good example you could remember. Now, the format. Okay, I see some students, they make their own format, but this is kind of a formal format we'll be using when you do a bank reconciliation in a company. The left, we always start with the business name. We indicated this is the bank reconciliation, and then with date as today's date. And then we always start with the bank side first on the left side. Start with the bank balance, right? That was given. And on the right side, listed your book's balance and all the reconciliation items. So we can see that on the left side, we see banks first. So the bank started with the balance, listed those two balance, and start with the bank side. Deposit in transit, we have to add it back. The correction, right? Because the bank deduct $100 from the other company, suppose not under my company, we have to add it back $100. Then we have outstanding checks on the bank side. So we listed all those outstanding banks checks. Now we have adjusted bank balance, $6,243.97. When we finish the bank side, we move on to our book side. We start with the book balance at the end of the month, right? We'll put in there. And now we're looking for those items we for sure is going to go added in. EFT receipts of rent revenue, which was recorded into bank, but not in our books yet. So we added it back because it's revenue. Bank connection of note receivable. So we're supposed to receive this money. Okay, so bank received this money first, and we have to record it in our books as well. Interest revenue related to this bank balance. So we have interest revenue earned. We have to add it back. And there is a correction of the book errors. We overstated the amount of 360. It's supposed to be 150, but we recorded at 500 something. There are $360 more. We need to add it back. Now, then there's a subtract. We'll have service charge that is stable, right? This account never changed. So service charger always been subtracted from your book side. Non-sufficient funds checks always on your book side. EFT payment of insurance expenses. This is the money we need to pay, and this has already been paid through your bank side. So that's why you need to deduct it from your book side. Okay. Then your ending balance will be exactly the same as your bank balance, $6,243.97. So that is how the procedures to do. You will have 4 or 5 practice questions to do a bank reconciliation. They give you different kind of situation, but basically this example is a perfect example because basically including every scenario so you probably will meet or see in your exercises. So now you will be okay. So if you're doing your exercises, you feel like you're in trouble a little bit, not understanding or following, take a look at this example again. This is the PowerPoint from your My Campus. So you will see that one. Okay. So that is the bank reconciliation. Pay attention to that. It's a big part. It's worth like 20 points of your final exam. Now this is a journal entry then. That is how you made the changes. See, we have our rent revenue, right? So we received the cash, we credit our rent revenue. We received the notes receivable, so we debit our cash and credit our notes receivable interest revenue. And the interest revenue from the bank balance, $28. So we debit our cash, credit interest revenue. Account payable, or debit or cash. This is the arrow, right? The book arrow. We recorded $360 last. So we have to record it more as we debit or cash. Account payable decrease of 360. And then the bank charge expenses, our cash come out. We have to pay the bank charges. So we debit our expenses and credit our cash. And following the account receivable is a non-sufficient funds, right, returned by the bank. So we have to deduct our cash and debit our account receivable, which is increased. And insurance expenses, debit and credit our cash, because we have to pay this monthly insurance amount. So the key steps, that is how you do that we just went through. At the very beginning, we know that you have to identify the closing balance from the bank statements, right? And the book cash account. So you always know the balance for those two accounts. Then you review your previous bank reconciliation. What information you can find from your previous bank reconciliation? That is mostly is the outstanding check, which means they will always give to you, like from the last month's bank reconciliation, there check number 1, check number 2 has outstanding, but check number 1 has been paid at the very beginning of the month. So check number 1 does not need to include it in your current bank reconciliation. The only outstanding check numbers will be for check number 2. Right, so that is the previous bank reconciliations tell you. And then we moved on step 3. Compare the bank statements and book detail. Cross out all items that can be matched. This is not shown in these examples, but most of the cases, they just simply list bank account and on the right side, book account. So the list check numbers, deposit amount or withdrawal amount. You have to take a look at from book to the bank account information, have a check mark to see, okay, so the book side is matched with the bank side and the book side match the bank side. When you have all the check marks, checks to matches, the left are the ones you need to do adjustment, right? So when you finish the checking, crossing over all the items that matched, then you need to adjust the bank side first. The leftover items on the book cash account and B goes to the bank arrow. Then adjust the book side, the leftover items on the bank statements, and then to the book arrows. After you finish them all, make a journalized entries for all reconciling items for the book side. Normally, we're not asking to do a journal entry. If you're doing a computerized accounting system, they will automatically give you a journal entry. So basically, you need to understand how to do a bank reconciliation. Okay. And the interesting thing is, if you are doing a QuickBooks, for example, all the bank reconciliation is you simply just have a check mark to match from the bank side and book side. The left amount will automatically shows you what is the differences. Then you just need to do adjustment on that. It's much simpler. Manual has always been the tricky parts actually. Okay, so yeah, so we have talked about that. We went through the. Now we'll move on to 4. Objective number 4. Apply internal control to cash receipts and cash payment. How do we implement internal control for cash receipts and cash payment? Internal control over cash receipts ensures that all cash is deposited and that the accounting records are correct. Okay, cash receipts over the counter. Use a point of sales terminal, like the cash register, with a drawer that only opens when the transaction is recorded and the receipts issued. Most of us probably have experiences for cashier. So you know that, right? When you receive the money, the drawer just open one time and then close it. The register should be positioned so that the customer can see the amount entered. At the end or several times a day, depending on the volume of the business, employee with cash handling responsibilities should deposit cash in the bank, with the machine tape going to accounting, serving as a basis for the journal entry to record sales revenue. So you can see that tapes always match with how much money or how much cash in your drawer. Cash receipts by mail. All incoming mail should be handled by a mailroom employee who send the customer check to the treasurer for deposit and who send the remittance advice to accounting for the cash receipts to be recorded. I remember I used to working for the AP group, like account payable group. So where treasury and account payable group are different. Early morning, the treasury will deposit the check. Account payable persons will record that remittance paper. So we'll have to enter that one into our computer as SAP. I remember it was an SAP system though. Yeah, so treasuries deal with the checks and the accounting people deal with the remittance for the cash receipt. The bank reconciliation down by a third person compares the bank's record to the cash account in the general ledger. Many companies use a lockbox system to separate the physical custody of cash from recording the cash. Customers send their checks to a lockbox at the bank, and the bank directly deposits the cash into the company's bank account. So nobody within the company will deal with the cash. Now, there is another thing. I had a question regarding that topic. Cash short and over. Cash short and over is a count we used to record small differences when the amount of cash recorded does not agree with the amount received. It should net to zero in the long term with small arrows going either under or over. We had examples for cash short and over. We see right there. Suppose the tapes from the cash register indicate there is a sales of $15,000, but when you check your drawer, you find out your cash receipt was $14,980. So you're $20 short, right? How are you gonna record it in your journal? Because the cash doesn't match. So you debit your cash, that's the real money you saw from your drawer, is $14,980. And then you're supposed to have $15,000. So that is your sales revenue. Okay. Then your cash is short. You add it back to the right cash. You record it as cash short and over account, $20. So that is your daily cash sales. That is your journal entry to record it yourself. And there's other things you're probably gonna see is regarding the petty cash account. Petty cash account is just a total cash, real cash account for those small expenses you need to use for your daily business, right? Like a postage, or what else? Like a small office supply, right? Probably just a pen or a few 2 or 3 pens or something like that. So those are the things. Very easily to get a cash short. We're gonna, I think, oh yeah, we're gonna talk about in the next topic anyway. So internal control over cash payment. This is at least as important as controlling cash receipts. So the check provides a record of payment. The checks must be signed by an authorized official or preferable 2 signatures. Signing official studies the evidence supporting the payment. Okay, so if you need to pay. Controls overpayment by check. Oh, this is the check. Okay, now we're talking about the controls over purchase and payment. The purchase and payment process follow those steps. Prepare a purchase order, which we call the PO. And then the supplier slips the merchandise and mail the invoice. So you place your PO, you tell your vendor that's what those kind of products you need to purchase. And then when the supplier get ready of all the products you need, and then they will send an invoice to the company account payable department saying that you need to pay. When those products has been received, right, then there is a receiving report we call RR. So that report shows the goods has been completed and the products has been received. And then after that, the accounting department will make a payment. So that is account payable departments do. Okay, so the purchase order always being sent out from supply chain department, procurement. Yeah, procurement department. So their supply chain. They do the purchase order, and the purchase order copies should go back to the account payable department. There will be a specific person to deal with the PO receipts. Then the supplier send the invoice to the AP group. So the person who deal with the PO will have to match that invoices to be received, right? When the procurement department receive the products, the real products, then they will match, send a recording to the AP person and seeing that we received the products. Then the person have to match with the PO, with the invoice, with the RR, and they are able to issue a check. So that is the 3-way match. It has been applied to most of the big companies, especially for those oil and gas companies, because they're like 10,000, 1 million. There are a whole bunch of monies coming in and out. So it's very important rules for three-way match. If by any chance you're going to looking for jobs in the procurement department or supply chain department, you will see this three-way match a lot. It's a very popular policy. Now we are moving on to the, what is that? Payment packet. So cash payment by checks. That is the procedures. We just talk about it. So there's a purchase order first, and then the supplier mail out the inventory and send out the invoices as well. And when the company receive it, they just pay the check to the supplier. Right. So that's the procedures. Now this is the petty cash topics we just mentioned. Apply internal control to petty cash. Petty cash topic. What you need to do is pay attention to the journal entry, replenish. When you use off your petty cash, the journal entry you need to remember, like how to do a journal entry. Controlling petty cash payment. Establish a petty cash fund allows control over expenditures too small to pay by check. If it's like a postage, $2, you don't want to write a check to it. So you just take a money or real cash from your petty cash account. Okay. And the following controls should be established over the petty cash fund. First of all, designate a custody of the fund. B, keep a specific amount on hand. Or C, support all fund disbursement with the petty cash tickets or voucher. So that is always see that you have a petty cash account with $200. And then you have a tickets, that is the total expenses happened, right? So we call it petty cash tickets. And then you have to establish or replenish all those funds. So we'll see examples. Creating a petty cash fund. Assuming on January 31st, business create a petty cash fund of $400. Journal entry to record it. Debit, petty cash account, credit, cash, because the money we took out and put it back into the cash petty cash account, right? Remember, there's no journal entries are made for all the payment until the fund is replenished, which means each time when you spend money, when you issue the tickets or vouchers, you do not need to prepare a journal entry. The only time you need to prepare the journal entry is when you start the fund, when you replenish the fund, when you put more money back. Now we see examples on there. On March 31st, the petty cash fund holds $230 in petty cash and $164 in voucher. What that mean? That means you have $230 on hand, right? You haven't used yet. And $164, that means you have been spending that $164 in the voucher. You spend it out. Now, how do you know there is a missing? This is the calculation. How do you know there's something missing? Now we have 230. Our total amount should be 400. Use 400 deduct 230. How much you got? You got 170, right? Yeah, 170. Thank you. So you got 170, but your tickets shows that there only 164 has been used. Then there is $6 missing. So that is how you calculate that $6 amount missing. Right? But following the calculation, you can see there are 400, and then there are 230, and their petty cash tickets 164. The total is 394. That is 230 plus 164. So there are 394. And your balance deduct the 394, it's the $6 missing. So that is another way to calculate $6. Then when you prepare a journal entry with the cash short, you debit all the expenses. Remember, so 46 plus 34 plus 84 supposed to be 164. So supposed to be your tickets. And then you cash, you know that you has been used $170, which use your total balance 400, deduct the cash on hand. So you have your cash 170 has been used. And then on the debit side, you have all the expenses, 164. So you have to plus $6 cash short. So that is how this account looks like. This is how when you replenish the petty cash fund, that is how the journal entry looks like. Now pay attention. This is $400 bank total amount, right? So we see that, what is that date? January, I think. Say we see January 31st. We start, January 31st. We start to create a petty cash fund $400. Now move on to the March 31st. Then you need to replenish. And you decide to replenish to $500. So that then means there is 170. Okay, because you have to add back that $100. You will see that example in your exercises. Okay, make sure that you have to add that back. No. So I cannot find that example now. You should have seen this in your exercises. Then because you're gonna move from 400 to 500, they're gonna be $100 more. Then your cash, because you have to put it back, then you have to add that $100 in there. So it should be 170 has been spent. That's the total expenses. And then you have to add in that 100 under petty cash account, and also there is a cash account. So both increase $100. Okay, because your total count changed. You will see that examples. When you have troubles, let me know. Now we are going to move on to reporting cash on the balance sheet. Now the cash is the first assets listed on the balance sheet because it's the most liquid. Okay, businesses usually have several bank accounts and petty cash funds combined, which is called cash and cash equivalents. So you will see cash and cash equivalents mostly from the bank statement, the balance sheets for almost all the business. Cash equivalents including the term deposits and certificate of deposit. So now the last part, we're going to talk about ethical parts, right? We always talk about ethic in each chapter. Other steps we can follow when making ethic business judgment. So most large companies have a code of ethics. We have this code of ethics designed to encourage employees to act ethically. There's sometimes a PDF files, or they download it and give to all the employees. But the problem is if everybody actually read it or not. Okay, so you have to make sure that managers following the code of ethics, and then the employees actually read the code of ethics. So that's basically the rule. Ethical issues in accounting require the accountant to make a choice. In illegal situations, the choice is easy. However, in case where no law is being violated, the accountant is forced to make a choice that could have serious implications of the reputation in the profession. It can be a very difficult choice. Framework for making ethical judgments has been provided from our book. So like CPAs, chartered professional accountants must adhere to the code of ethics. The rule of professional conduct has been set up by SCPA Canada. So every year when you renew your designation, they will ask you, have you read the code of ethics? We ask everybody. So it's very important. It's always being emphasized. Now this is the how to make ethical decision. This is a decision guide. What are the facts? So you need to determine the facts. What is the ethical issue, if there is any? Right? Most of the companies want their net income or balance looks good in their financial situation. So that is kind of you increase their revenue or decrease the expenses, or sometimes increase the expenses to make the revenue a little bit lower if they wanted to do a tax return. So those are the kind of situations you're facing if you're going for accounting career. Now, what are the alternatives? You need to do nothing is always alternative. So you could choose do not do anything. on that. The most often questions I've been asked as a public accountant is for tax preparation. If it's small business, you will ask, I don't want to pay taxes, what am I going to do? Even though for you guys, right, for our personally, we're asking if there are some other ways I don't need to pay taxes to the government. I could receive more refund. So those are the critical questions that you have to seriously think about it. If there are other way, you do not want to be unethical or make unethical choices because you're going to be hurt by your reputation. Now, when I talk about this, I have a personal experiences to share with you guys. 2 years ago, I think, not 2 years, yeah, 2 years ago, the company I've been working with, they help a few people are looking for a tax preparers. So they find a public accountant. She had an accounting firm. She's CPA, of course. She helped people to do a tax return for personal tax return. And then everybody has to sign a form when the third party prepare your tax return. You remember you need to sign a T183. That is an electronic file form. And there's also T1013. So that is a authorization. So if government has any questions, you authorize this accountant to help you to deal with the CRA. So that is how that works. You sign the form. But interesting is when people sign the form, they didn't even notice that the form actually has two different check marks. One is for the current year authorization. Another is for the all future years authorization. So if you sign the form with all the future years authorization, even though you're not doing your taxes with this accountant, she still has access to your personal taxes with the CRA because you have been authorized her. But then we don't know, right? We have no idea. We signed a form with assigning her for all the future income taxes. And then 2 years later, for some reason, she did a tax return and she electronic filed it. She sent the tax return to the government, and the government turned out and asking us to pay more than $50,000 to the government, and they're saying your own CRA money. Now, then we have to find it out what we did wrong because we have to pay over $50,000. If you're not paying on time, you're going to pay a lot of interest. Then we find it out and going back a few years and then find out, oh, we signed a form and this person without any notice sent out the tax return without any credit included in. She just simply put a total income amount without any income taxes being deducted, without any RSP has been contributed, without all the information of the family members, just sent directly through her company. That caused a big problem. Okay, so that is my personal experiences. It's not very happy experiences, but just let you know, very easy for those accountants to make unethical decisions. So be careful, even though for a customer, when you sign the form, when you're asking the third party to prepare your taxes, read that form very carefully because you have to make sure what you're signing. So this is for our today's lecture. Any question? Oh, yeah. Fazila, you have a question?
Sorry, teacher.
Okay. Oh, okay. That's good. Okay, so that is for our today's class for lesson 8. It's not complicated one, right? I believe some of you already did your exercises. It's just a lot of exercises, but the content is not that much as level 1, right? You only have 4 chapters. And trust me, for chapter 9 and chapter 11 are all those things you already learned. Okay? It's for account liabilities, account receivables. So those are very easy things. I hope you enjoy your study. Let me know if you have any questions. Send me an email. I'll try my best to respond to you as soon as I can. Thanks for coming today.